Good morning, good afternoon, everyone. I'm just going to give one more minute to let a few more people roll in, and then we'll get started. All right, Allie Peters here, coming from my kitchen. And we've got Rob Spady presenting for us today with a few possible chime-ins from Bob Petkoff. So if you have any questions during the presentation, please do just write them in your question box, which is on your GoToWebinar there. And what we'll do is we'll make sure that we get to them at the end and I get all of those questions over to Rob. But I know we're pressed for time today, Rob, so why don't you take it away?
Thank you, Allie. Good morning, everybody. Welcome to our presentation. We're going to go over the top 6 opportunities that we're seeing the most activity out of, the most production out of. None of them are revolutionary, none of them are brand new, but they are very effective, particularly in this time of uncertainty. People are hunkered down. They're trying to look into the future, not seeing very far, but we all have clients that they would like some help with planning and they want some solutions that can help them create some certainty in their lives in this very uncertain time. So we're going to jump right into our top 6 topics. On our agenda today, again, it's creating certainty in uncertain times. We're going to talk about our life insurance review, which is absolutely critical right now, given all the changes in the variables that drive a life insurance policy. Getting your financial house in order, the new stretch IRA planning because of the Secure Act, the fundamentals of multi-generational planning, wealth transfer for qualified assets is fundamentally changed. Asset-based long-term care, annuities, just regular old annuities. As I said in my comments in the first email, they're not just for breakfast anymore. And talking about the estate tax window that is closing, and getting into that in detail and why, we have clients out there that, regardless of what's going on in the marketplaces or in the economy, the broader economy, are still going to be very wealthy people. They're going to be facing estate tax issues, wealth transfer issues in the future. And then we're going to just talk about what to do next to proceed with this. Life insurance review. Why do the review? When we first wrote the insurance review and we talked about sustained low interest rates, back in the day, that was 3%. Now, most people would kill for 3%. Our 10-year treasury is floating in the 60 basis point, 70 basis point range right now. We've had increased costs of insurance because of the prolonged low interest rate environment from the last crisis that we went through in 2008 and 2009. Carriers have repriced a lot of their older products, increasing the mortality charges from the then illustrated current assumptions to higher or even guaranteed assumptions. Plus, they've tweaked up the internal expenses on their old books. There's a lot more reserving requirements for the insurance companies. There's been 3 phases where they've upped the amount of reserving. Now, in hindsight, given where we are in this economic crisis, it's probably going to be a good thing. We've got carriers that have 4 and 5 times their statutory reserve requirements on their books, and that just provides financial strength in times like these. Carriers have pressures on earnings. There has been improved mortality tables. We've gone to the CSO 2017 mortality tables. People are living longer, and that's going to change pricing on new products. There's been a lot of underfunding over the past few years inside of life insurance. We see it all the time with policy notices coming in. And some clients may be looking for resources to get through this period of time, and you can help them. Should they access their existing policy? Do they have cash values? Can they use them? If they do use them, what's the plan to get them back in there? Is there a better way or a more efficient way for them to generate income off their policy cash values? And then we also need to review improper ownership structures. Hey, we bought this as a part of a key man policy between dad and son, and now dad's not even in the business, and we've got this policy at the corporate level. What should we be doing? As well as the beneficiary structures. We're going to talk about beneficiary reviews. That in and of itself, whatever your client has, whether it's life insurance, annuities, qualified plans, it's time to review those beneficiaries and find out that are the people they want to have the assets should something happen to them, the ones that are named beneficiaries. Because I will tell you, it is almost impossible to get a beneficiary payout changed after the death of the account holder. So in-force policies, again, all of these factors have changed, and now we're looking forward. There's been a lot of changes. People should see, are their policies doing what they want them to do? You're going to need the client's assistance. This can be done over the phone. You can call the client, say, here's the process I'd like to go through. A lot of people are sitting at home with some time on their hands. They might want to take some of that time, stop binge watching Friends and maybe focus on some things that are causing them stress, the unknown of how are their assets performing. What do we need? We need copies of annual statements for all the policies to be reviewed. Really need to get those from the owner. We need a signed in-force illustration request. The client signs and we will submit. Many carriers are going to take several weeks, and most carriers will only send them to your clients because it's going to require a follow-up. And then some basic medical information. We've got a quick quote form that you get completed by the client. You can send it to them. They can fill it out. You can talk to them over the phone and fill it out. Now, there are times, usually when we have this amount of information right here, we can do a very thorough policy review and analysis. And the other part of this is asking the client, okay, why did you buy the policy? Is that still the reason why you have the policy? And in your ideal world today, what would that policy be doing for you? Some discovery questions to help us find out what's the best solution. Like they may have bought the policy for pure death benefit at the time. They had two small kids, want to provide for the family, had a big mortgage. Now they're approaching retirement. They've got this policy. They got cash value in that policy. They don't really have any more debt. The kids are all off through college. What should we be using that policy for? And we can sit down and go through alternative solutions for them. We did this program back a few years ago in 2016. We did it as a contest with one of our relationships. And we ended up doing it in a 2-month period of time. We did 304 audits. It resulted in 109 apps. Now, you might say, wow, that's only a 33% close ratio, right? Well, actually, that's pretty good. And the reason is that we really are objective in these audits. If the client has a policy that is doing what they need it to do, and it's a high quality policy, and there's not a better solution out there, we're going to tell them, you got a great policy, keep doing what you're doing, or hey, you have a great policy, you might make it even better if you make some tweaks here as to what you're doing. And our intent here isn't to change policies. Our intent is to provide our clients an objective audit and show them, do they have what they think they have, and is it going to do what they think they want it to do or expect it to do? And so of the 304 that we did, I would say at least a third of them, we would say, look, your policy's doing great. You should keep it. Great company, great allocation, whatever. Or we help them tune it up and say, keep what you got. There was a significant portion of those people that their health had changed, and there wasn't another option for them because their health had changed and they weren't going to qualify for better underwriting, or whatever they were going to qualify was cost prohibitive relative to what they had. And so, again, we couldn't help them or optimize that solution, but we could help them optimize what they currently have to get it to the best outcome based upon what they told us that was. And then of the 109 apps we took, we got 95 placed. 31% of the total apps that we policies that we audited, we ended up placing $67,800,000 of death benefit, and we closed almost $1.2 million in target in 2 months. All of these were designed to put the client, your client, in a better place. We're here to help. We'll provide all the info from the previous list to your core relationship managers. If you don't have a relationship manager, call in and ask for Bob Petkoff or the case design team or myself, Robert Beatty, to help you get connected with a relationship manager. Core's case design team will complete the analysis and provide a summary. We provide very thorough analysis, and really the output that you will get will lay out several options for your client. And then we'll meet with you over the phone. We'll share the results of our audit, discuss the next steps that you need to take with your client, and help you prepare for your client meeting. So tools to get started, we have our life insurance review checklist. It's quick 10 questions that you can go through with the client. Can be done over the phone with the client. We have social media posts that you can put out on your social media saying, hey, this is something I do, or this is, if you're interested in this, here are the resources I provide. We have letters and email texts that you can start. You can start, as it says, the minute this webinar is over. We can send you out materials. We also have printed materials. We have 4x9 cards that you can mail to your clients. Or put them on a placard in your office when a client comes in. They're really nice, very simple, very clean summaries that say, here's what an insurance audit is and here's what it can do for you. Again, reach out to your relationship manager today, reach out to Case Design. If you need marketing assistance, you can reach out to Allie Peters. All of our contact information is here on this slide, and you'll see it at the end of the presentation as well. The next thing is get your financial house in order. This is another topic that you can reach out to clients. This one is, this one is not geared towards anything other than helping your clients get their financial house in order. And again, it's to help create certainty in uncertain times. We're in a chaotic, uncertain, and stressful times. Key sources of stress for people is finances. I mean, it's everywhere. If you watch 60 Minutes this past Sunday, it was all, people were more stressed about the financial consequences of what's going on, more so than even the health consequences. Even the segment that was on the healthcare crisis in rural America, it boils down to them running out of money, not necessarily not wanting to help or have the resources. They're just going to run out of money. Same with the farmers in the story, and same with all the people that have been unemployed. It's finances. And we have found over the years in our experience that most people have their financial picture organized like their kitchen junk drawer. I got a kitchen junk drawer. I will tell you, with this little extra time in my hands, it's very well organized right now. And I'd like to ask, how many of you have organized your closets, your cabinets, your garages? Why? How did you feel when you were done? There's something comforting about bringing order to things that you can control in times of chaos and stress. When the world is surrounded with events that are completely out of our control, we like to take control of what we can. People have anxiety and uncertainty about their financial well-being, justifiably so. This isn't imaginary. This is very real for a lot of people, for most people. You can bring some order, and you can answer some of the hard questions they have for themselves, and you can help them get a handle on it. You can bring order to what feels like chaos, and you can reduce stress, create certainty, and provide peace of mind for your clients. And again, you don't need to meet kneecap to kneecap with them for this. You can send this off to them. You can set up a conference call. You can walk them through the process. So get your financial house. It helps your client identify and organize all the parts. I mean, people, they've got their savings accounts, their checking accounts, they've got their debt, they got their investments over here, they got their insurances over here, they may have a trust and legal work over here. It's all fragmented. It's rare that we meet with a client that they've got all their ducks lined up and it's an organized place, and they come in with this neat folder with all of their moving parts in order. I mean, that's not been my experience. You can document where everything is for the client in one place, identify what they have, identify what they don't have but should consider having, identify their income and help them get a handle on their expenses, identify their assets and for many people right now, their liabilities. You can help them identify things that can be eliminated. If they're looking for ways to cut back on expenses, sometimes just putting it in an organized fashion, going down the list, going, wait a minute, do I really need that? And can I reduce it or line item that out? You can get a handle on deficiencies and shortfalls and address them with your client. Help them get a handle on what's going on. And it's the same, maybe I'm weird, maybe it's just me, but when you're done organizing your closet, or you're done organizing your junk drawer, and you're done organizing your garage, whatever it may, you sit there and go, okay, I feel good. I got a handle on this. It's clean, set up. I know where everything is. I got rid of some junk that I didn't need, whatever it may be. There's a serenity to that helping get order out of chaos. And again, it can all be done remotely over the phone. Guide your clients from chaos, uncertainty, and stress to order, clarity, and confidence. Creating certainty in uncertain times. Tools to help get started. We've got a customizable get your house in order piece. It's a nice piece. Get your house in order. We can customize it with your logo. It's got some language here that helps, you can send to the client, say, here's what we're trying to do here. This is the object of what we're doing. Again, this is not sales generated. You will identify opportunities, but they may be they may be things they can't address for 12, 24 months from now, right? It's not about that. This is about helping your clients, endearing yourself to your clients, delivering value to your clients just because you can. And then you got a one-page balance sheet, cash flow summary. There's a checklist, by the way. There's a second page or third page to get your house in order. It's got a checklist of things for the discussion with the clients. We've also got a one-page balance sheet, cash flow summary. Listen, we've had it for years, and whether your client's worth $100,000 or $100 million, it's a one-page summary for your clients to see where they are. It's, and I have used it with $100 million clients. It's not obviously drilling into the turnover ratios and the alpha and beta of their American Funds, Growth Fund of America, but it does give you a big picture. And when it's completed, it also is glaringly jumps out off the page of you as where are the gaps and deficiencies? Like, holy cow, they don't have anything in the life insurance box. Well, they might want to consider that, or they don't have anything in the disability box. Or their car insurance, they got state minimum limited liability stuff. You can just look at this sheet, and it's pretty amazing. And then we have a more comprehensive booklet called the Family Love Letter. And this is a book that you give to the client. You can walk through it with them, or you can hand it to them and say, hey, this is just a gift from me to you. If you don't have a structure for putting all this stuff down, and it lists where is everything? Who are their advisors? Who's their attorney? Who's their CPA? Do they have trust work done? Who's the trustees? What bank accounts do they have? Where? What investments do they have? Where? What debts do they have? Where? Who's the mortgage provider? And what it is that if that person should become incapacitated or pass away, it's something their family could go to and look at and have a really firm handle on all the moving parts that they need to address at a very difficult time. So and just for themselves, it's like, you know what? I know I got something. I never forget doing a life design for a client, and 3 weeks into it, she remembered she owned 2 condos in Florida. I'm like, oh well, I guess you could misplace those, but it's a very powerful book, and we have it for you. We're ready to provide it. Again, reach out to your relationship managers or the case design team to get started. These are resources we want to help you with. Again, you can reach out to your clients, email things to them, conference calls. It can accomplish all of these tasks remotely. The new Stretch IRA. The Secure Act had lots of changes in it, and there's actually a few changes in this CARE Act that went through with regards to minimum distribution requirements and all kinds of weird esoteric distributions calculations in it, and I'm not going to drill into those. I'm focusing on the bigger picture, non-spousal beneficiary change for qualified plans. It changes intergenerational wealth transfer planning dramatically, and we're going to focus on the Secure Act. Quite frankly, a lot of the stuff that's involved in the CARE Act with regards to qualified plans and minimum distributions, if any of you have listened to Ed Slott talk about it, one, it's extremely technical, and two, it's a very narrow window and a very narrow segment of people that are probably ever going to consider taking care of it. I'm shocked that they put that much effort into those to what they did in that act. But we have that information should you ever want it. But we're going to focus on the Stretch IRA. So the Secure Act was supposed to be revenue neutral. So how did they decide they're going to pay for it? There were a lot of goodies in there. You know, RMDs go out to 72. You can contribute to a 401k or an IRA as long as you're working. Doesn't matter how old you are. Ease up on some of the rules so that small businesses could band together. All that stuff. So how'd they pay for it? Well, they took away the non-spousal Stretch IRA. They took away multi-generational stretch outs on qualified funds. So in their minds, in their calculation, well, okay, if we accelerate distributions out of the IRAs, it's going to generate the revenue that'll offset allowing people to put more money away and defer it longer on the front end. So bye-bye non-spousal Stretch IRA and hello planning opportunities. So they limit the non-spousal IRA beneficial distribution to 10 years. Now that 10 years, you know, there is no, each year there's a minimum amount. It's if you inherit it day one, you do not have to take a dime out of it as a non-spousal beneficiary until day 365, year 10. So you can sit and let it defer for 10 years, but the problem is you get that lump sum coming out in that year. It's going to play havoc with your tax situation, drive you into higher effective tax brackets, all kinds of things. There are no more life expectancy calculations for non-spouses. The spouse can still elect to roll over to their own IRA or maintain as a decedent beneficial IRA over their life expectancy. Also, dependent children not subject to the 10-year rule until they reach age 18. Other than that, the IRA balance divided by 10 and Bob's your uncle. If you wanted to spread it out over 10 years, which would be the most efficient way to do it to minimize income taxes in any given year for the beneficiary. So the net effect is potential substantial generation of tax revenue by accelerating the distribution of qualified funds from retirement plans by decades. So something that could have been stretched out over 20, 30 years is now coming out in 10. So the government giveth, and then the government taketh away from someone else. The poor don't have IRAs. The middle class will spend their IRAs. So this really is going to affect the top 10%, 1%ers with regards to planning for their IRAs. So there's an ability for the affluent to affect multi-generational wealth planning with qualified funds will be significantly curtailed, at least under the traditional planning scenario. So where's the opportunity? Well, you can, the IRA holder can start lifetime distributions while they're alive and invest the distributions, if they don't need them, into non-qualified assets. Leave those non-qualified assets to their heirs. They get a step up in basis at death, but then the heirs are going to face taxation over their lifetime. They can purchase life insurance and leverage the distributions into an income tax-free and possibly estate tax-free benefit to one's children and or grandchildren, or even multiple generations of posterity. And quite frankly, this is the replacement for the Stretch IRA, is take the money now, use it to leverage, use it to buy life insurance. That life insurance will provide an IRR on a guaranteed basis that's, you know, it's going to be comparable to investing in equities and having a bull market the entire time before you die, and having the balance go to your heirs. You can keep it in the estate if there's not an estate tax problem, but we'll discuss that later. And leverage it into both a life benefit and an income tax-free long-term care benefit. You know, the client could do two things. They could use some of the proceeds to buy an income tax-free long-term care benefit on themselves now, as well as using another portion of it. It doesn't have to be all or nothing. They could optimize the outcome for their heirs multi-generationally, or they could use some of the distributions to purchase themselves a tax-free long-term care benefit and provide for their heirs, or any combination in between. So you can put it into an ILIT that is also a multi-generational dynasty trust. It distributes income, but not necessarily principal to generations, thus avoiding all future transfer tax. Sorry, that's a typo, generals. I don't have any generals in my family. Whatever they may be, and providing lifetime protection to heirs against liability and tort. in case Teddy drives the family wagon off a bridge with his girlfriend in the passenger seat. So you can set up a dynasty trust. A dynasty trust, for all intents and purposes, is going to look like a multi-generational stretch IRA. You can not have the principal coming out. You can have the income coming out. You take your distributions today out of the IRA for the person who owns the IRA. Typically, they're not earning income, so it's an income tax efficient way for them to pay the income tax now. Take the net distributions after tax, purchase a life insurance policy into an ILIT that's also a dynasty trust. The death benefit pays into it. Again, the IRRs are very efficient, and then they take distributions out over the children, grandchildren, great-grandchildren's lifetimes. And then you do multi-generational planning where you can keep replenishing that trust and keep it intact. If anyone's heard Ed Slott talk, whether on his PBS special or some of the carriers, or one of the carriers we're working with, he did a phenomenal job. I will tell you, he was touting this solution before they changed the stretch IRA provisions. He believes that even before the Secure Act changed, that this was the most efficient way to optimize the outcome for qualified assets over multiple generations. Because the other thing is that if it goes into there are no RMDs once it's out of the IRA. The life insurance doesn't have RMDs. The trust doesn't have to distribute anything other than what the trust says it has to. And again, you get asset protection. You get income tax-free death benefit. You can get tax-deferred growth. Roth IRA treatment on accumulation and distribution. Ed Slott is not a life insurance guy per se, although, you know, if you hear him, you'd think he was being paid by the life insurance lobby to keep saying what he says. And you're like, look, I'm not being paid to say this. It's just a fact. If you look at the math and you look at the tax code and you look at the efficiencies of life insurance, it's one of the best long-term financial planning tools available to the affluent today. So some other things, again, if the client doesn't want to deal with life insurance on a window, you can have there's many other strategies available out there to optimize that IRA asset versus just leaving it to a non-spousal beneficiary with a 10-year lump sum distribution requirement on it. We've got tools and resources to help you with this, and feel free to call us if you're not familiar with our stretch planning. Again, reach out to your relationship manager, reach out to Case Design. We're here to help. We'll have more tools and resources for that available when we do our individual breakout webinar focused just on that topic. Another thing that we're seeing tremendous activity on is asset-based long-term care. Long-term care statistics, at least 70% of people over the age of 65 will need some type of long-term care services prior to their death. You know, the average length of long-term care claims that last longer than 1 year is 3.9 years. And the average life expectancy, if it's a dementia or cognitive issue, you know, it's 4 to 8 years. And I've heard of people living 10 and 12 years with cognitive impairment. You know, it's something that many people face. You know, I use this analogy. If there were a 50% chance your house was going to catch fire, would you insure it? Almost everybody has homeowners insurance, by the way. But there's less than a 1/3 of 1% chance that your house is going to experience a fire in any given year. And, you know, based upon the total number of housing units, the odds are even less. If you look around your neighborhood, typically within a mile radius of your house, there might be one fire in 10 years. I mean, these are pretty low odds, and yet everyone I know has homeowners insurance. The lifetime chance of someone who buys a policy at age 60 will use their policy before they die is 50%. So 50% will use their policy and 50% won't. The actuaries did this based upon a 0-day elimination period, which means that benefits start right away. So what are asset-based long-term care strategies? This is where you can do a lump sum, you can do a 5-pay, 10-pay, we now have even lifetime pays where you can buy asset-based long-term care, which is basically a universal life policy with a long-term care rider, but it is designed to optimize the long-term care benefits, not the death benefits of the policy. And what do you have? You have guaranteed benefits, you have guaranteed premiums. It's not like traditional long-term care where, you know, every week I get emails from Genworth telling me that they've got a rate action taking place somewhere in the country, and it's been going on now for years. They can't raise their rates fast enough on their traditional long-term care policies. Well, with these policies, the premium's guaranteed, the benefits guaranteed. In many cases, you can get 80 to 100% of your premium back from these policies, some from day one, some after year 5, some after year 10, but the client can get a do-over. We put our money in there, and where else are they going to put their safe money right now? I mean, has anyone looked at what the banks are paying? After taxes, what are they really yielding? So they put their money in here. 5 years from now, they can get it all back. They want to change their mind. The reality of it is that less than 1% of these types of policies have lapsed over the past 27 years because people recognize what they have and they like it, and they stick with it. The money stays in the family, so it's not one of those situations like car insurance, homeowners insurance, or traditional long-term care where if you don't use it, you lose it. You pay your premiums, never have an accident. State Farm doesn't give your money back. With these policies, if you never use it, your heirs get the death benefit income tax-free, or you can surrender the policy and get your cash back at a later date. They're very simple to understand. We have one and done or flexible premium payment options. You can pay with cash or can transfer existing cash value life insurance to fund the strategy. Very shortened underwriting process. These are simple, like 5, 6, 7 knockout questions. Typically there's no liquids or exams. You either qualify or you don't. And there's options where you can have a reimbursement policy, which is similar to traditional long-term care, or an indemnity policy where once you go on claim, they just start sending you checks. And there are pluses and minuses to both of the strategies, and it depends on what your client's circumstances are. So what are the cons? Well, the best leverage is when a lump sum investment is used, but it's not required. It typically requires $50,000 or more in total funding. And there's not a whole lot of options right now over the age of 70. It's just, particularly in this environment, carriers were slowly tightening up on that to begin with, but now that we're in this environment, we're having carriers lock up big time on issuing policies on anyone over 70, traditional and asset-based long-term care. So here's an example. You have a married 65-year-old female. She repositions $100,000 as a single premium. At issue, she gets $4,275 a month in benefits, a total pool of $331,000. At age 80, because it has a 3% inflation adjustment, she'd have $6,661 of benefits, a $516,000 pool. If she never uses the benefits, her death benefit at issue is $164,000. It does decline over time, but between the ages of 86 and 120, she's got $102,000. So basically, her family gets all the money, transfers to them as beneficiaries of the death benefit. And she has a liquidity feature, in this particular case, to increase the long-term care benefits. We chose an 80% return of premium benefit, but she can get $80,000 back at any time in the policy. Has a 0-day elimination period, and it was a reimbursement policy. Got questions about asset-based long-term care? Again, reach out to us after the call. Reach out to your relationship manager. Reach out to our case design team. We've got tools and resources. We'll do all the design work. If you've got clients with money sitting in the sidelines, particularly in this interest rate environment where they're not getting paid very much at all, give us a call. And to transition, if you got people sitting around with money at the banks getting paid what banks are paying right now, you need to take a look at annuities. They're not just for breakfast anymore. And it's going to be quick. We have fixed MYGAs right now, multi-year guaranteed annuities that are beating similar duration CDs by as much as 50 to 100 basis points. Right now, a 3-year CD, the top rate I could find today was 1.6%. The top 5-year rate for a CD I could find today was 1.8. I went on the internet, Googled it. You come here, their top rates. So again, right now we've got products paying 2.3 on a 3-year and 2.6 on a 5-year. So that's a pretty substantial. Plus, it's tax deferred. Plus, it's at an insurance company, not a bank. Last financial crisis, not a single insurance company failed. As I said, coming into this crisis, most of the insurance companies have substantially more reserves and surplus on their books than they did going into the last crisis. You need to look at index annuities. How does an index annuity work? Well, if the index is low when you buy it, and a year from now the index is higher, you get some rate of return, typically greater than what you're going to get in a 5-year or 3-year MYGA. And, the markets are low right now. Could they go lower? Probably. I mean, there's some serious economic news coming down in this quarter that I don't think is priced into the market. But still, long term, if you're buying a 3, a 5, a 7-year MYGA, where's the S&P going to be? Is it going to be low? I guess it could be lower in 5 years. That'd be bad. But I'm just saying it might be an ideal time to take a look at index annuities because you invest low and hope it goes up. We have a good chance of that in this environment. People have uncertainty. They ought to be looking at single premium immediate annuities. Let's guarantee their must-have. This is the money I have to stay in my house, to pay my taxes, to put food on my table. Well, how great would it be if you could say, okay, we can guarantee that from here on out, and here's what that would cost. Now, in this low interest rate environment, it might not be the ideal time to buy a SPIA, but depending on your client's circumstances, they got X number of dollars, and you're looking to optimize the maximum cash flow off of that. Every time you run that type of analysis, you have to look at what a SPIA will do for your clients. Particularly, the older they are, the better the leverage and benefit's going to be because of the shorter durations the SPIA's got to pay out. We have some tremendous income guarantee riders. Yep, a lot of them are pulling back right now. A lot of them are curtailing what their benefits are. But compared to other options in the environment for guaranteeing income, they're still very attractive relative to what our clients' choices are otherwise. And then we've got long-term care annuities. You got clients that have traditional annuities with substantial, put $50,000 in, it's worth $100,000. They know they'll probably never use it. Well, you can take that and put it into a long-term care annuity where they can get the full $100,000 out income tax-free to cover long-term care benefits or long-term care premiums. And several of the products that we have will take that $100,000 and leverage it into a $200,000 or a $300,000 pool of long-term care assets, all of it income tax-free. So I think people, again, we are in unprecedented times. People are thinking about their health. They are thinking about their mortality. They're thinking about their morbidity. They're thinking about themselves and their families. Long-term care, quite frankly, as I said, the expense isn't as unexpected as, what we're going through now has been unexpected. But it's in the same mindset. And people will take solace and comfort in knowing that they can get something like that pinned down and resolved, and they can say, you know what, I handled that part of my financial household. So again, annuities, creating certainty in uncertain times. We have fantastic annuity resources to help you. Please reach out to us, reach out to your relationship manager, reach out to our team. Here's just a summary of rates. At Reliance Standard, our top rate is 2.6%. Our top 3-year rate is 2.25%. Sorry, I overshot on that one by 5 basis points. Our top 7 years at 3.5%. You might say, okay, 7 years. I'll tell you, 3.5 at 7, that's not too bad. If you look at what the 10-year Treasury is paying right now. So we've got some good options out there. Give us a call. Let us know if these are going to be a fit for your clients. So again, great team available. We have access to all of the top insurance carriers out there with regards to annuities. I will qualify that with, you're going to see carriers out there that are going to offer better rates or better whatever. You need to take a hardcore look at their financials. Many of the carriers out there that have these, that's too good to be true stuff that they're showing. They're B+, B- rated carriers. We don't represent any carrier that has a rating of less than A-, AM best. Okay, so, and I will say in this situation, financials do matter. Though in the last crisis, not even the worst financially rated carriers. There were a few I thought were going to crack that didn't in the last financial crisis. But I would say financials matter when talking to our clients. Let's stay with the A companies. And then I'm going to finish up with the estate tax window, because I think this is important, and I think that we need to take a longer term look, although I don't think this window is very long term. So what's the opportunity? Well, in the Tax Act of 2017, they doubled the estate exemption from 5.6 to 11.2. Now it's 11,585,000, I think. 22 plus million per couple. It's a huge wealth transfer opportunity. And any estate tax on anything over that's at 40%. But it's very important that people understand this sunsets 12/31/25. And it could sunset sooner. It's only as good as the next administration in Congress. It can be repealed. It may be repealed at this year in the November election. There may be a political outcome that sets the landscape for this to be repealed first 100 days of the next administration. And after 2025, if nothing's done, we revert. We know this. This is the fact to 5.5 million plus 11.2 million for a couple. And so I'm going to talk about the country's fiscal situation. When I wrote this next slide, it didn't include any of the $3 trillion we have let loose fiscally to rescue the economy as much as possible in this crisis. So, quite frankly, it's the largest opportunity for any person alive today to transfer wealth to the next generations. It's probably the best we're going to get in any of our lifetimes. And now is the time to plan. And I know people are hunkered down, but the high net worth and the ultra high net worth, they're looking at ways to take advantage of this crisis as opposed to surviving the crisis. And I think if you have high net worth and ultra high net worth clients, it's an opportunity to engage with them. So let's look at this. Right now, our total aggregate debt, and this was done at the end of last year, beginning of this year, was $22.5 trillion. We have the fourth highest debt to GDP ratio in the G20 after Japan, Italy, and Singapore. The tax cuts of 2017 are estimated to add between 1.9 and 2.3 trillion dollars to our national debt, above the already additional projected 9.8 trillion dollars that was cooked into the books for the next decade. So we were looking at $11 trillion in additional debt over the next 10 years. The 2019 deficit, it actually came in a little under the number that I have here, the $1 trillion number I have here, but it was double the deficit in 2018. And we are projected to run this was before this crisis. We were projected to run $1 trillion plus deficits for the next 10 years if spending was not cut. Well, we've gone in the opposite direction of not cutting spending. We're looking at running huge deficits above $1 trillion for the next 3 to 5 years on top of what we just threw at this. I mean, they're still talking about a $2 trillion infrastructure stimulus package. They're talking about a third round of payroll taxes. There's even conversation about paying a monthly income almost indefinitely to people, not just the $1,200 that everyone got back from the government for, as a tax rebate, but they're talking about paying that, considering paying that to all the eligible recipients like a month for an extended period of time, basically this guaranteed income. So anyways, and plus over the next 75 years, Social Security deficit exceeds $13 trillion, and the Medicaid number got cut off, but that number is actually closer to $20 trillion. So what are our possible scenarios coming up in the next election? So let's look at it. If Trump wins, we may have at least until 2024, maybe make it to 2025. But given the current troubling financial crisis has already been aggravated by the COVID stimulus, what are the odds of the current levels of taxation, income, and estate tax being politically tenable? I mean, there's Republicans now that are balking at any more stimulus just because, I guess they're starting to blush. I don't know where that reaction was prior to this, but they're like, oh my God, what are we doing? What are we doing to future generations? And I think that anyone that's going to come out in the next 5 years and says, oh, we need another tax cut, I don't know. It could happen. Stranger things. And if Joe Biden wins, and right now they say if the election were held today, he'd win probably by a 5 to 6% margin based upon all the calculus that's going on. And again, 6 months is a lifetime in politics, so who knows? But he said on the campaign trail, day one, he's going to repeal the 2017 tax cuts. Day one. Now, he doesn't have that authority. Can't be done by executive order. He's going to have to get Congress to pass it. But it could certainly get done on his 100-day agenda. There's talk that the Senate's even in play now in this next election. He wants to revert back to a 39.6% income tax rate. He wants to double the capital gains rate to 39.6% for anyone making over $1 million. He wants to revert to an estate tax exemption of $3.5 million per person with a 45 to 55% estate tax. And to boot, he wants to eliminate the step-up in basis at death. That's some serious curtailment from our current situation with regards to estate planning. So what are the odds? I don't know. I dropped my teacup in the wishing well and I haven't seen the future since. I don't know what the future holds. What I do know is what the law is now, and it will be that way at least through January of 2021, possibly through December of 2025. I believe we have an opportunity and still a sense of urgency for people to start planning now. You may not have $22 million estates, but what about a $3.5 million estate? You got a client that's got $3.5 million and they're in their 50s or 60s. They need to take a hard look at what that planning looks like. And even if you don't have the 3.5, what if you have retirement funds that you'd like to benefit your family for future generations? Life insurance is a powerful tool used to leverage tax favorable treatment, private beneficial transactions to achieve your desired outcome. So when someone asks me, when should I do the planning? Well, yesterday was better than today, which is better than tomorrow. So again, sense of urgency. We've got some materials on this if you'd like. We're going to do a breakout that focuses on this. That'll be a quick call because there's not a whole lot of moving parts to it, but it's how do we instill a sense of urgency in our affluent and ultra affluent clients that they really need to be looking at taking advantage of. Plus, with their assets discounted right now, it's an ideal time to transfer assets that are probably at a discounted value to what they were even 12 months ago. So what does it mean for the prospect of future taxes? I don't know. But if you were betting your family's future, which way would you hedge? It's important to note that no matter what happens, this all goes away at the end of 2025. And I'd like to close with the fact that, hey, we have e-platforms to help you do everything. Licensing and contracting, to get appointed with the carriers or help you with your CE, is your CE current, is your long-term care CE current. You have all the moving parts you need to do this kind of business. We have a tremendous automated licensing and contracting system. Send us an email and we'll take care of the rest. We have IGO, drop ticket, and e-application resources to streamline the submission process. Can all be done over the phone and over the computer with your clients. We have no exam, no fluid, no APS underwriting up to $3 million of face amount from multiple carriers. We have jet issue solutions with quick turnaround times. We had a case that we submitted. We submitted the case 2 Wednesdays ago and got approval on it last Monday. It's a $30,000 life target case. Boom. The clean case got done. We also now have carriers that are working, and some have, and some are going to have shortly. You can pay premiums electronically. They don't have to write you a check, send you a check, and you overnight this and all that. I mean, there are electronic payment processes being put in place. And then ultimately, we have e-policy delivery, where we can get the policy emailed to you and your client. They can sign off on everything online. They can download a copy of the policy in a PDF, save it wherever. It's always going to be at the insurance company that they can get electronically. You can have an electronic. All the delivery requirements can be executed. E-policy delivery. It's a wonderful thing. Very quick. If any of you have ever signed a DocuSign document for whatever purposes, I mean, it's that quick. Boom, 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 done. So everything from submission to commission can be done without ink on paper and faster than it could ever have been done before. This crisis has spurred many of the carriers that were dragging their feet on this to get it done. I will admit, we're dragging, we've had these resources available for 12 to 18 months and some of them longer. We drug our feet on implementing and enforcing it. We were good at it. We're really good at it now. So let us help you. There's still ways to do business with your clients that want help creating certainty in uncertain times. We've got a portfolio of solutions. None of it's rocket scientist. It's basic planning. It's basic 101 planning, and our clients are hungry for it in these chaotic times. We're going to do a series of breakouts on each one of these issues, deep dive a little deeper into the resources we have available. We'll probably open those up to a dialogue question and answer during those, just so we can have dialogue, answer questions. We are going to keep those. I'm sorry, this one has gone longer than I anticipated. We will keep those calls. We're going to try and keep them to 20, 30 minutes tops, depending on the participation and feedback. So we've got this schedule. We'll be sending that out via email. You can also go to our website at coregroupusa.com/webinars and check what that schedule is. We have other workshops coming from our product providers. A lot of our providers have tremendous resources to help in this time as well. So we're going to continue bringing them to you. And ultimately, call us. Case design, your relationship man. You can call it, you know what, you can call the 800 number and say, I need help. Someone will get you help. Someone will get on the phone and help. Ultimately, we'll get you to the right team, the right person based on what it is you're calling in that you need help with. That's my presentation. If anyone has any questions, I'll open it up. Bob, is there anything you'd like to add?
No, Rob, I think you've about covered it all. Thank you.
Rob, I'm not really seeing any questions popping up, so I think we are all set. I appreciate you doing this for us today. If anyone does have any questions, oh, somebody just popped up. Just kidding. Let's see here. It just says list of. Bart, I don't know exactly what you're asking for, but you can give us an email. My email is apeters@coregroupusa.com. We'll be sending out an email with all of the different webinars, and each of the webinars will have a series of materials that will support you. So yes, you will receive those. Again, just shoot me an email. My name's Allie Peters, or give us a call. Thanks, Rob, and we'll see you guys on the next webinar. Tomorrow we have Lincoln MoneyGuard at 1 p.m. Eastern Standard, so I hope everybody can join us for that. Have a great day.
Thank you, Allie.
Thank you, Allie.